For most people, applying for a loan feels like a simple digital action. A form is filled, a button is pressed. A result appears on the screen: approved or rejected. What is rarely visible is the process that happens underneath that moment. In many modern financial systems, the decision is not made by a person sitting at a desk. It is made by automated systems designed to evaluate risk using data. These systems operate quietly, quickly, and consistently. And they now play a central role in how lending works. Not long ago, loans were decided very differently. Applicants met loan officers in person. Documents were reviewed manually. Questions were asked, and judgment played a role. Human decision-making allowed for flexibility. But it also introduced inconsistency. Two people with similar financial situations could receive different decisions depending on who reviewed the application. The process was slow, costly, and difficult to scale. As banks expanded and the number of applications increased into the millions, this approach became unsustainable. Financial institutions needed decisions that were faster, more consistent, and easier to manage across large systems. That need led to automation. Banks began using statistical models to assess credit risk. Over time, these models became more advanced, incorporating machine learning techniques that could analyze large volumes of historical data. Today, when a loan application is submitted, it is typically processed by a risk assessment system. This system does not see a person, it sees data, income history, payment history, credit usage, patterns of financial behavior over time. Each application is converted into a structured digital profile and compared against millions of previous cases. One common misunderstanding is that these systems rely on a single number, such as a credit score. In reality, modern lending models evaluate multiple factors together. They look at how stable income has been over time, not just the amount. They examine spending patterns and how predictable those patterns are. They assess how credit has been used, including frequency and repayment behavior. The focus is not on individual events in isolation, but on patterns. From the system's perspective, financial behavior becomes a set of probabilities. A missed payment is not interpreted emotionally. It is recorded as an event that affects risk calculations. Consistency is not viewed as effort or intention, it is treated as predictability. This is why explanations and personal context rarely influence automated decisions. The system does not know why a payment was missed. It only knows that it happened. Machine learning models are trained to recognize patterns that historically led to specific outcomes. If certain combinations of behavior frequently preceded loan defaults in the past, the system learns to associate those patterns with higher risk. If other combinations were commonly followed by successful repayment, the system learns to associate them with lower risk. This learning process is based on historical data and statistical relationships, not personal circumstances. This approach explains why two applicants who appear similar on the surface can receive different decisions. They may earn the same income, live in the same city, apply for the same loan amount. But their financial behavior over time may differ in subtle ways. Small differences in stability, timing, or usage patterns can accumulate. Across millions of cases, these differences matter. The system does not compare people. It compares trajectories. From a bank's perspective, automated decision-making offers significant advantages. Algorithms apply the same rules consistently. They do not become fatigued. They do not change standards from one application to the next. This consistency reduces uncertainty. In financial systems, predictability is valuable. It allows institutions to manage risk, comply with regulations, and process applications efficiently. Once automated systems demonstrated that they could reduce losses and increase efficiency, they became deeply integrated into lending operations. One consequence of this shift is the emphasis on speed. Decisions that once required days or weeks can now be made in seconds. But this efficiency comes with a trade-off. Most automated systems do not provide detailed explanations to applicants. The output is simple. Approved. Rejected. The reasoning remains internal, embedded in models that are complex and not easily translated into human-readable explanations. This trend is continuing. Automation is expanding beyond loans into areas such as credit limits, eligibility checks, and real-time risk monitoring. Human involvement in routine financial decisions is decreasing. In many cases, human review only occurs when applications fall outside predefined thresholds or require manual intervention. For most applicants, the decision process remains entirely automated. Artificial intelligence does not judge character. It does not assess intentions. It evaluates patterns of behavior and estimates risk based on historical data. The systems making these decisions operate quietly in the background, influencing access to credit across modern economies. They are not visible, but they are central. The next time a loan decision appears instantly on a screen, it is worth remembering that it was not random. It was the result of patterns, probabilities, and calculations. It was processed by a system designed to decide quickly, consistently, and without human involvement.